going to be in the morning. It's going to be 5 p.m. and the class is to be announced, like the group. Okay?
5 p.m.
5 p.m.
Tomorrow is 5 p.m.
Okay.
The one we had after McDonald's?
Yeah.
I mean, tomorrow was supposed to be 1 hour, huh? Look at it. Tomorrow was supposed to be 1 hour.
1 hour?
No.
It's not my fault, I'm just the messenger.
Sí, tomorrow was 1 hour and a half.
5.
Yeah, it's going to be 5 p.m. I'll put the message on WhatsApp when I have meeting.
Where? Que hablan más fuerte, coño.
Entonces mañana tenemos que hablar con Juan.
Ah, ostras, claro, sí, verdad.
O sea, lo fuimos solo.
Salvo que lo quieras pasar para el jueves. Como quieras, honestamente yo.
Vale, luego hablamos.
Vale.
¿Sabes a qué hora abre la cafetería?
Okay, guys, good morning.
Morning.
We are going to finish the chapter 1, and it's an applied, as we commented yesterday. It's going to be very applied. I'm going to introduce bonds and the essentials of bonds and valuation. And for us, the objective, the goal is going to be valuing this asset. We are going to use this adjusted approach that's of everyone. So the fair value of something today is going to be the discounted sum. Typically we have in periods, can be infinite though, but in this case it's going to be finite. We will have just, in this particular case, 4 cash flows. So we will construct the expected value of the payoff, right? And this expectation in case of fixed income is very simple because it's determined contractually. We will have someone who has the oath, who is promising to pay 150,000 in a given date, 450,000 later, 225 next year, and finally 474 in 2028. And we want to discount all that amount to the present. That's our theory. We want to work with those expectations, but because we are risk averse, we need to discount with something which is the risk-free rate plus certain premium. We will discount that from the period in which that cash flow appears to now. That's the theory, and that's what we need to do. So, very simple things here. First, how we are determining that risk premium for fixed income. Typically, banks charge some fees amount. They put you in some bucket according to your credit quality, and they charge you systematically something. So we are going to charge something like that in this exercise, 2%. You are going to perceive a complete risk-free, and we have this kind of idea, right? Risk-free, you were totally risk-free, that premium is 0. If I perceive risk, then I command an extra rate of return, that is what we call the risk premium. So, okay, 2%. And then we have the risk-free rate as a basic element to account for time passed. Now, the problem is, which risk-free rate should we use? Because the theory, typically in the models that we are seeing, we have one period. This idea of you are dealing with one period, right? And then associated to that period, you have the risk-free rate. But in real life, we don't have such a thing. We don't have a risk-free rate. We have different products that are traded. All of them can be considered risk-free. as much as you can consider risk-free something. But let's say this government, this promise, this bond issued by a government, which is kind of high, with high creditworthiness, that thing will not default. That's the closest thing we can figure out in terms of risk-free conditions. What happens is that that entity typically issues different bonds at different maturities. Here we are looking on different maturities. And we can compute for each of those maturities a yield to maturity. Typically, what happens when you go from yield to maturities of bonds to different maturities is something like this. As opposite to this idea of a single risk-free rate, that would be a flat curve. We don't have such a thing. Typically, the normal thing, the normal scenario, wherever typically you observe this yield curve, is something like this. An increasing function that tells you that when you lend to the government, because this is what happens. In reality, when you buy bonds, when you lend money in an increasing horizon, typically you command a greater return. You perceive greater uncertainty as time increases, and you charge your investment with something extra. Now the problem for us is which risk-free rate should we use? Bonds. So let me quickly introduce the idea of those bonds, what a bond is, for those of you who are not familiar with that. Bond typically has the structure, is called the coupon bond. The typical structure that we are talking about. So this is what typically governments do. In the case of Spain and all the other countries of the European Union, this is highly standardized. We are going to take a nominal value or a face value that is typically 1,000 euros. It's very small because it's meant to be able to be purchased by small investors. So a small investor will not be able to spend 90,000 euros, but 1,000 euros is okay. And if you have 5,000 euros, I will buy 5 of those coupon bonds. Those bonds are characterized by a nominal, which is the amount of debt that the government will pay at a given maturity. So we have another variable that is fixed contractually, and this is maturity. And then these coupons pay regularly a coupon which is determined applying certain interest rate, so to speak, to the nominal value. So let's say that we have a coupon of 3% annually. And let's say the maturity is 5 years. In Spain and all the countries in the European Union, the structure is the same thing. Then you have a product that over the next 5 years, in a given date, which is determined, is completely predetermined and fixed contractually, they will give you the 3% of 1,000, so that means a fixed coupon of 30 euros. They pay coupon, 30, that sequence of this fixed money, and maturity, you will get the last coupon over the period, so this is paid in, and is regarded as interest or accurate interest over the period, and at the end of everything, the government will give you back the debt. So because debt is sort of repaid, the debt contract finishes. Okay? It's redeemed. It's a debt is redeemed. These characteristics are fixed. That's why these contracts together refer as fixed income product. They offer you, they promise something that is fixed and predetermined, totally predetermined. You have a calendar, you know what is going to be paid according to that calendar, in that particular day, you will be given this money, and everything is predetermined. So those coupons and those nominal values determine the expectations. We don't have to figure out anything weird. It's not like when we value a project in a company that the most complicated thing is creating the expected value of the free cash flows. You need to figure out how much you're gonna save, what your salaries of the people that you have hired is gonna be, etc. That makes this expectation very, very speculative. The same thing happens whenever we talk about the stock market. If we have expectations of dividends, this is highly speculative because there is no commitment to pay dividends. So it's super speculative exercise. But fixed income products, this is smooth. We know exactly what is going to be paid, and the only uncertainty is whether when the day comes, whether the issue will sort of meet his promise, right? The question above is how much will you be willing to pay today for this promise? That's the only open question which is left to the market. Antonio issues a product. If this is a promise that says that I'm gonna pay 30 euros every end of December, every end of October, and in 5 years I will give you also 1,000 euros. And the question is, how much are you willing to pay for this promise? If that price, which is market driven, equals the nominal value of the bond, we say this is trading, this is part trade. If you give me a lot of trust, you will be willing to pay something greater than the face value. And if you don't give me that much trust, because this is supply and demand, the price of the bond will go below the nominal value. These three scenarios can occur depending essentially on supply and demand. And the demand of bonds is determined by creditworthiness. The more you trust me, the more you will be willing to lend me money. The more you will pay for the same bonds. So price is the open question here, price is the variable. Depending on how much you want to pay, this system creates the yield to maturity that determines the return that you will extract from the bond. And this is gonna be the solution to this equation. You will have to pay this amount. And in exchange, you will be given that series of coupons and coupon and nominal value at the end of the maturity period. At maturity. So the yield to maturity is the yield, the rate that solves this equation. You will have second bond, right? 2 billion, and then we end up in the last one, coupon plus nominal. That's in my case 5 years. If I put it in more general terms, right, symbolically, we will have n periods. And then we observe the inverse relationship between the discounted factor, which is the yield, a constant common rate that we are using in this expression, and prices. So the yield and the price have played in opposite directions, as we have already discussed in the course. The point is, this is an equation. This is known, this is fixed, fixed, fixed. The question is, you can give me the yield, and then I will use this expression as a pricing equation, as a pricing equation that we've been discussing in the course. So you give me the coupons plus nominal, and the yield, they will determine the price. If you give me the yield, then the yield is the required return. This is how much you are willing for your investment on a fixed income product. You demand 6% to lend money to Antonio. And if you perceive more risk, you may ask at 8% rather than at 6%. The yield is going to be determined it's going to be a measure of creditworthiness, as we saw last week, I think, or a couple of weeks ago, when we discussed the yields to maturity, right, around the world. this yield to maturity essentially is the premium required for creditworthiness. And SOIF is determined in the case of the 10-year bond like that. You will have the bond paying over 10 years. The 10th year you will get the nominal value. That yield is the solution to this equation, given that in the market you will get that price. So we can play with these two. In this equation, we can play with which is the input and what is the output. What is the question that you want to solve? You give me the yield, then that is the required return, and then that the question is, what is the fair value of the bond? What is the price of the bond? You are pricing the bond. And the question can be reversed. I give you the price of the bond, the other characteristics are fixed. So the question is, how much is the yield? So then you give me the price of the bond. This yield is the expected yield. That's the expected return. Is this clear, guys? The difference between required return or required yield and expected yield. We are emphasizing the idea of whether you know it's something and you are using that as an input. If you give me the required rate, then we use the yield as a required rate, as a rate to discount and determine the value. We use that, we solve the pricing equation. But if you give me the price, because we observe that in the markets, then what you get is the yield to maturity, and that's the expected yield or the expected return, and it's called the yield to maturity. If you hold the bond until maturity, and you pay today this amount, and you trust that you will get all this sequence of money over time, this return, this promised return to maturity will be this one.
I didn't understand the part of the price of the bond being greater or less than the nominal value.
The nominal value is 1,000. How much will you be willing for my promise to give you 30 euros over the next 5 years, and at the end of the 5th year, 1,000? How much will you be willing to pay for it?
I don't know whatever the price is.
You determine the price. You are the buyer. How much you are willing to offer?
So I'm like the lender.
You are the lender. The whole purpose of this is a financial asset. The whole purpose of a bond is for the user is to get money. I'm giving these promises because I want your money. I'm not the student. And I will have to give your money back. That's it. That's the difference with equity. Equity is I want your money, but I may not give you your money back, never. So you take this thing. You assume this risk. And then you are not willing to take that risk. That is, I want your money, and typically I will give your money back, plus some return as a compensation for time and risk. How much will you be willing to bid for my bond?
I don't know, 1,100.
Oh, thank you. Very generous. Then, if this is the case, because I'm giving a 3%, the yield is going to be how much? Greater than 3%, smaller than 3%, or bigger than 3%? In Roberto's, we can express he's willing to buy my bond in terms of price, so he's offering a 1,100, but we can also put it in terms of the yield. And because the coupon is 3%, we know the coupon because this is determined contractually. How can we say about the required return of Roberto? Roberto
That's the
doesn't.
part I didn't understand. I'm not willing to give 1,100.
Oh, that's what you told me. And you changed your mind.
No, because
Yeah, but those
if
pesos
he's
is-
only gonna give me 1,030 at the end of the period, then I'm not willing to give 1,100. I'm willing to
But
give
this is what you
1,900.
told me. I will give you a 100.
You will give me the.
You give me 1,100,
No.
and I will give you 30, 30, 30, 30.
No.
Why not?
No, because it makes no sense. I think giving more than.
Makes no sense. Do you think this equation makes no sense?
No, there are bonds that are trading at a premium. It's just the required rate of
It's
return.
how much are willing in this case, in this context, you are showing that you trust me a lot. You really consider my bond a good bond. That's what happens with the German bonds. That's what happens with the US bonds. A lot of people is willing to buy those bonds. What happens to the price of those bonds? Because these are fixed. They cannot change. So supply and demand, you will have to pay greater value. What happens to the yield when we get this high price? It's going to be below the 3%. The cost of debt, the rate of return, the yield to maturity of this bond will go below the 3%.
Because you need to pay.
But Roberto is not willing to say that. Antonio Carramo, now I understand what is going on. You're just a professor. So not 1,500? How much, Roberto? And that's fine. That's fine. 100?
900.
900? Then what is not happy with the yield?
It's gonna be higher than that.
So we see the perception of risk of Roberto's perception of risk. He's saying, Antonio, you are promising a 3%, and this is not changing. But what happens is 3% is not enough for me. I want more. But I cannot give you more because this is a contract with fixed characteristics. I'm offering 3%. If you want more, the only way in which you can get this extra is via price. So with a 900, the yield to maturity will be somewhere below 3%. Is this clear?
Yes.
Now, can an interest rate to be negative?
A real interest rate.
A nominal real interest can be negative.
Japan had a negative interest rate on the road.
Can an interest rate be negative? No. Can the yield of a bond be negative?
Ah, yes.
Why?
Because
So when you see the interest rates are negative, this is a misperception. It's not the interest rate what is negative. It is the yield of a bond what is being negative.
that's what happened in Japan.
Well, in Europe too.
Yeah.
3 years ago we had that scenario. Switzerland probably they have this scenario, I haven't checked, but probably even the Swiss have near zero yield bonds. Why? A bond can, when a bond can offer a negative yield.
Because there is a lot of demand for them.
And then what happens?
The yield goes lower.
The price increases, and increases so much that the yield is going down. So if you put a high demand for those bonds can eventually, theoretically, have a negative yield, which is a kind of aberration if you think about it, but it's what happened at the end of the day, and it's what happened up to 3 years ago. What is the interpretation of a negative yield? We give it the interpretation of you are paying a fee for the custody of your money. So it's like the situation is so twisted that in a normal scenario, when you lend money, when I take your money, I need to give you some extra return for you on exchange of that money. I need to give you a premium. The situation is so twisted and changing that we need to understand the current circumstances with a negative G bond situation in terms of you are giving me your money and it's you who pays me for the custody of your money. So we go back like 500 years in time, at the time to the Templars, when that was the scenario. In the very beginning, when people who used to take my gold, take my crown, and the Templars, who were like a sort of elite warriors and kind of, really bad guys, really tough guys, say, literally, if they want your money, they need to kill me. That's my promise. But I will charge you something for the custody of your money. So this situation we saw in the European Union up to 3 years ago. No, yeah.
But why would people then, like, it's way more effective if you keep your cash, right?
But you have
It's
been
like stratospheric.
under your mattress.
Yeah, I don't see how that
That's
market
what many people do.
negative
They
yields
put their money under the mattress. What happens when you have $100 million? What happens when you have $1,000 million? There's no mattress for that. So you go into this type of want you to give my money, let's say that I'm sort of a lot of fear, there's sort of special circumstances, and I'm okayish with you asking me for getting the money. In the circumstances, the yield to maturity is negative. It's not going to take minus 1%. It's close to zero, but negative, extremely below zero. That's kind of anomaly. In the European Union, the reason is different. It's not because of fear. Or you could see fear, but eventually it's fear. But what happened in the European Union is the ECB buying everything. It's well famous, whatever it takes, of Mario Draghi, saying whatever it takes, we are not gonna let the peripheral countries down. We are gonna be there, whatever it takes. Meaning, I'm going to buy your bonds. If people believe that your bonds are close to default and they are not willing to buy your bonds, I will buy your bonds. So I'm artificially manipulating the market. That was the reason why Spain was on rescue. If we had been let the market free, a country like Spain would have been intervening. You don't have anyone buying your bonds. But if like the equivalent of the Uncle Sam in the US, right, comes and says, no problem, how much do you need? 1,000 million? I'm gonna give you 1,000 and 100 million. That's fine, take it. That's what we saw reflected. And the price for that has been inflation. Why prices have been skyrocketed in the European Union? Because we were flooded with money coming from the European Central Bank. Of course, this is a kind of disequilibrium situation. You are solving one problem, and economists are very good in this thing. We are very good in solving one problem, and at the same time creating another. Because things, of course, don't come for free. You want to sort of solve the situation artificially, there is something to be paid. Only most people will not understand the situation, right? They're like, oh, we are okay. I can go to the bank, and the bank has kind of money to lend. Okay, that's activating this is doping your economy. But the price eventually of this situation of flood of money is inflation. Because you have distorted the loss of the money.
I didn't understand how do you consider or have an inclusion of the required rate?
Depends. The question is, you want to solve this. This is the question. This is the question, but the question must have a single unknown. You want to determine the price, or you want to determine the yield? Because then you need to feed the question with the other variable. Those numerators are known and fixed. But the question is, you want the price, then you need to give me the yield to maturity, the discounted factor. Then we call it the required return. This is what the market demands for the bonds, and this is fluctuating. That's showing the perception of risk and the demand of people. And when that increases, and we see people requiring more money, they are scared. And then if we want their money, we need to give them more money. And the other way around is when you feed the model with the price. You observe the prices. So you solve for the yield to maturity. And this is what happened here. When you come to this expression and say that, for instance, today, the Spanish yield is like a 3.13%. It's because this equation has been solved by whoever did this, released this information. So we can figure out how much people are requiring, because in equilibrium, expected return and required return must be the same thing. So right now, in the conditions, people are demanding 3.13% in Spain when they demand 3.4% to the French bonds. So we sort of learn something. People are more scared of lending money to the French. And this value comes from this equation.
One question, so on this side that you're explaining on the bonds, like, let's say for the 900, like you're willing to pay below par for a bond. Technically, the yield will be 3%, the coupon rate 3%.
One thing is the coupon rate,
Yeah, for that.
and then another different thing is the yield or the cost of debt. required rate. That's different.
Then your costs, you said like if you're below the par, then the yield to maturity will go up. Right?
Yes. the more, because the natural thing here would be if you lend 1,000, you should give 1,000.
But technically, if you're buying a 900 and you're still getting 3% coupon rate, that 3% over the price that you pay is not 3% anymore. Technically, right? Because
You get a 3%, but
You get-
because you
Pay
buy
the-
a discount, the total profit is bigger than 3%.
exactly.
So that's the only way in which we can sort of produce, figure out that return that you're requiring.
But also like on the company side, because I work for companies that buy bonds as an investment tool, just
The
risk.
same behavior.
Yeah, but
the same kind.
they're looking for how interest rates are going.
Only that yields will be greater. The difference would be if this is not a government bond, as a firm's bond, that yields will be higher because then you have much more uncertainty about whether the company can sort of fulfill those commitments.
Okay.
But the mechanics are the same. The only difference, another important difference, is that the bonds issued by a government are highly standardized. So always the same mechanics. Whereas a company can do whatever they want.
Technically, as interests go up, like the new
So
bonds are-
required returns increase,
and then bonds, the curve
will go down because the coupon is fixed. So let's say that we issue a 3%. Next year, the interest rates go up. And let's say that in the economy, a deposit will give you a 6%. And remember, my bond has from today until maturity has a coupon rate of 3%. Next year, interest rates go up to 6%. Who then, in his right mind, will buy my bond? You lend the money to the bank gives you 6%, my bond gives you 3%. So how can the market correct this mismatch? Via price. If you demand a 6%, my bond needs to give you a 6%. Only that I cannot give you that money via coupon. Coupon is 3%. So if people are requiring a yield of 6%, the price bond needs to go down. You will produce the 6% that you need via buying super cheap.
And that's where, I guess, from the firm perspective, we're buying a lot of bonds. A lot of, like, at least the company that work for, they're trying to estimate what's gonna happen with interest rates. So they wanna buy.
When people say, oh, that's a kind of safe investment, people say, you are not getting the idea.
Yeah, exactly.
This is a financial asset traded in the market. So it has the same resources, only that you are different exposed, right? It's not the same as buying a stock. But when you told me about, is that not, I'm not exposed to market risk price? You are exposed to market risk price. You are exposed to default price, default risk. You are exposed to inflation because these coupons are going to be nominal. I will give you 30 euros. But what you can do with 30 euros 5 years ahead will depend on inflation.
It's kind of the similar mechanics when you have the loans that have a fixed rate plus a SOFR rate that you're expecting not to go as much, right?
Say that again?
You know when you use the SOFR, the floating rate, you have fixed rate plus the floating rate. So that's kind of the same mechanics, right? When you have
Only that more complicated. You replace a fixed interest rate by a floating. Most investors are running like that. Because
That's why-
investor, the guy that buys bonds is a kind of risk-averse guy. Not so much risk-averse, is not going to buy these financial assets, but it's someone who dislikes risk. He's not buying shares. He's buying something that is promised. So they want things very transparent, very clear. That's what this product has this structure. There are floating interest rates, but typically those are offered by the private companies. Governmental bonds have this kind of very transparent, simple thing, because the point is to get as much people, as many different investors involved as possible.
And those securities are usually notes, right? Like traded in money
Notes,
markets,
when you say
right?
note, you have a maturity which is below the year.
Right.
That's the note.
So it's
It has a
money.
different mechanics. The note is issued without an explicit interest rate. Note is a different thing, is a different animal. The note is typically below the year, and what happens is that they promise a fixed amount, so 1,000. We'll pay you in 6 months 1,000. No interest rate, I don't give you any interest rate, it's me just telling you, listen, I will give you in 6 months now 1,000 euros. How much are you willing to pay for this? No interest, less than 1,000. Typically, these loans are set at discount. You will buy this product by less than what they redeem, right? What they promise, and your gain, your interest rate, comes from the difference in prices. When we take this idea of notes to the world of bonds, we call it, and this is very important, zero coupon bonds. And this is super important. So we have this difference. If maturity is below 1 year, we call it notes. That's typically financing, very short-term operations, and the interest rates are typically determined through the yield of this product. It's very short-term, and this is really determined by the economic policies. You control over the short term, but longer maturities, you cannot control what people are going to do, right? So over the 1 year, the dynamics is not just typically this simple operation, but if you have bonds that mimic the behavior of the note, and it has a maturity over the 1 year, we call it zero coupon bond. And the idea is that simple. So let's say that we have a bond that it has a maturity of 3 years. Typically, you will expect coupon plus nominal plus face value. Instead of that, you just have nominal 3 years ahead. You will buy typically this bond at a discount, at a smaller amount. We call it zero coupon bonds. No interest.
But you
No, more risk in the sense that you get nothing along the way. Yeah, that's why these bonds are not naturally traded. You will not typically interested. They can be constructed artificially, and there is something called streets.
And that's what the financial engineers do.
Where people do these sort of things. This is something that most investors will dislike. The idea of not getting something along the way, right? Everything at the end of 3 years, 5 years horizon. So you don't see these products typically constructed. There is something that is called a street, which is constructed from a normal coupon bond, which is, we can see, let's say for instance, a 3-year bond as something that pays coupon, and coupon plus nominal. So strips is like a sort of breaking this bond in 3 products. One that pays a fixed amount, which is a coupon 1 year ahead. Another product that pays a fixed coupon 2 years ahead. And another product which is coupon. And another which is the nominal. Or if you want to put it in simpler terms, let's say that this last payment is sort of sold separately. Those are called strips and can be done. Because there are a lot of people in financial markets interested in doing many things. There are some people that will be interested in buying just this type of coupon. And you can see the price of the whole bond, when you are saying, I'm paying this amount today, I'm paying this amount for this strip, and for this strip. All 3 together make the total price. What if I just want to buy a part of the total? You can do that with strip bonds.
So it's a part of the.
It's a part. You can buy a part of that, reproducing this structure. Zero coupon bonds are not something that you typically are going to see naturally, but are super important for us. Super important for us because it allows you to see your expectations, your expectatives in a pure, simple way. How much you are willing for this product without any intermediate payment. It's just, waiting 3 years. If if I have to wait 3 years to get 1,000, and I'm willing to pay 900, this is my perception of risk involved at this particular time horizon. And this is more pure than the coupon bond, because if there are payments and repayments that can be reinvested, it's kind of the same idea, but more guilty. For that reason, when we construct the yield curve compares, right, plots the yields to maturity of 0 bonds. The yield to maturity is constructed by saying you are going to pay this amount today, and on exchange you will get certain nominal value 3 years, 4 years, 5 years ahead. And we can solve this question very easily, right? The yield to maturity is going to be something like the price, the nominal value over the price divided by 1 over n minus 1. So if we construct this sequence, we observe how the expectations, how the expectations of the people about the economy are, because it's the same product, in the same conditions, no risk of reinvestment, no all this noise associated with the intermittent payment of coupons, just changing maturities, just changing the horizon of the investment. And that allows us to see a lot of information which is impounded in this product that is sort of reconstructed from the market. We see expectations, we see the price of expectations of something that has no risk. So they are, the yield curve is the yield, that's the yield to maturity of government bonds, maximum quality, meaning default free.
But regular bonds, right? Coupon bonds.
0 coupon bonds.
Who issues that type of bonds, bro? That do the governments issue those type of bonds?
They don't issue these bonds. We can construct these bonds are kind of artificially. Process the information.
Okay, that's
All right.
Ones who
So we learn from the bonds, and we sort of figure out the 0 coupon bond. There is no typically 0 coupon bonds at 7 years. Right? So you sort of kind of figure out artificially.
But there are government bonds. Well,
There are
that's-
government bonds with this
What
structure.
does it say?
There are bonds with that structure.
that's your coupon.
This is 0 coupon,
So 0 coupon government bonds.
which don't
We're
exist.
flying. So we're, okay.
Don't exist naturally, but you sort of, you can imagine, it would be like a street at the 3 years, right? You just consider you isolate, somehow you decompose the total price. And there are techniques to do that, we are aware of that, that would be a physical course. But to me it's important to distinguish these two things. First of all, what is what the government issues? This structure.
Yeah.
From that, we can sort of make up something that we call the 0 coupon bonds. And from the 0 coupon bonds, we plot the yield curve, because it reflects pure expectations.
So the inverse yield curve that people are afraid of comes from that one, right?
And when we talk about that, the information that the yield curve or the inverse yield curve brings, okay?
I don't understand how we get different yields when we don't have any coupon interest. Or not like no interest at all. Like,
You have
yield is
maturity,
one,
but you imagine that you can reconstruct that thing, right? So imagine that from a bond that has a maturity of 3 years, you can isolate somehow the payment of 3 years. And you can figure out how much someone will be willing to pay for that point payment 3 years ahead. And typically this is today a smaller amount. So you solve this expression and you get the G. Price would be smaller, that price would be smaller than the nominal value, that means a certain maturity. You plot this for different maturities. That's the yield curve.
and different face values.
Always the same face value.
Always the same thing.
Okay, it's just changing maturity. It's the same product, same conditions, meaning risk-free conditions, only that change in the maturity. And what you observe is how much people are requiring from an investment at different horizons in risk-free conditions. And we have this information every day. And this information is changing every day.
Because technically, like a 30-year bond, let's say 4%, and a 10-year bond is lower, right?
Is what?
It's lower, 2.5, for instance.
Typically we will say that people somehow, right, at the 30 year, let's say that they demand 5%, whereas at the, let's put it here, I don't know, 1 year horizon, people demand, I don't know, let's say 2%. They will say somehow people dislike, and there are theories, we have different theories to explain why the most natural thing, the most frequent thing that you observe for a yield curve is this upward positive trendy function. And there are different theories.
So the notes, I know that you said that the zero coupon bonds are like the notes, but outside the bonds.
Notes are traded naturally, but you don't have notes beyond 1 year.
Yeah, it's
Probably
not
1 year and a
like-
half, a maximum. So the dynamics are different. Then you have bonds that have that structure.
Because I know JP Morgan and those banks issue notes for a year, 11 years, 11 months, I'm sorry. So that will be basically, they will offer, like, for instance,
That's a zero coupon bond.
they will $1,100 for a $900 note, right? That's kind of.
Maturity at 11 years, no intermediate payment, that will be a zero coupon bond.
Zero coupon bond can only be trading in premium, or they can also be like premium, like for example.
Yielding and negative interest rate. That's what we said. This situation is possible if rather than buying the bond below par, you, for some reason, some sort of anomalous reason, you find people that are willing to pay more than nominal. So they give me 1,000, they give me 1,100 for the right of me giving them back 1,000 1 year ago. And you see why the hell they are doing that. You need to understand this negative yield as a premium for custody.
So we will say that the yield is the real P&L of the bond.
The real
P&L, like profit. That-
is is the rate of return, expected rate of return. The profit, but especially in a relative term. Okay?
Because the coupon is the nominal rate.
Coupon, yeah. And everything here is nominal, no inflation. The promise is nominal, so inflation would be a risk that any bond holder needs to face.
Yeah.
Okay, guys, it's understood. So this is the yield curve. It's super important for us because it's a source of information, and this is gonna be the most basic information that we're gonna check in the markets. People think immediately it's the stock market, but that's not. I would say the source, the first source I go to check in the market will be this thing. Forget exactly zero coupon bonds constructed, for instance. This is I'm going to show you later the US yield curve. This is the European yield curve, and it has been constructed starting from bonds which are AAA, so that's probably German bonds, and pretty much nothing else. And this has been constructing from very short maturity up to 30 years. And this is the curve, the typical curve that we observe, an increasing function, meaning when I look at the 30-year horizon, we have a 3%, right? 3.2%, whereas if you want to invest very short, you are below 2%. So for some reason, people seem to dislike or perceive more risk, and the required rate of return in the longer investment, risk-free conditions, we are lending to the German, that's greater. And there are different theories. Some people say there may be also liquidity conditions. People dislike the 30-year. There's no market for that horizon. Then you need to offer a premium, which is not just default or risk premium, it's liquidity premium. For that reason, we tend to stick to the 10-year horizon. A lot of people buy this bond. So this 2.6, 2.7, that's the sort of thing, that's the price of risk, right? Sorry, that's the price of time passing, no risk conditions.
What is inflation in the?
There is no inflation here.
No, in general, in the EU.
It's like around,
average, yeah.
should be around, is fixed around 3% as the objective of the ECB, but right now we are having greater than that.
So that's below.
All of that, everything that is below 3%, that's exactly yielding. Of course, in a very short term, you don't care, right? Over the long term, for 30 years, that's pretty much compensating inflation.
And the rest is
Zero real, exactly. In real terms, a joke, but this is what it is. Right now, this is changing. You check this curve tomorrow, it has changed. You see the yield 30 years or 1 year ago, it has changed. Now, I think Alex was mentioning something very important because the curve is changing over time, so it can be like that, or it can be like this, or it can be nearly flat, and sometimes can have a negative slope. Then we call it inverted yield curve. Inverted because we think that the normal position is this behavior. Long-term yields are greater than short-term yields. And we capture the steepness of the function, the slope of the function, what we call the term premium. Slope or term premium is the yield of a long-term bond in excess of the yield of a short-term bond. If this difference is positive, so put it, for instance, the yield at 30 years minus the yield at 1 year. Then we will say something like a 3%, and in 1 year or 5 years if you like, okay? To make it easier in this graph. At 5 years, we can check it actually. If I look at the 1 year horizon over here, 1 year and 9 months, right? That's at 1 year we have something like a 1.90. At 30 years we have 3.17. This spread, this difference is a proxy of the steepness of the function. The bigger the spread, the more steep the function is. When the short-term rate and the interest and long-term yield are sort of having the same profitability, we have that situation. And when the long-term bond has smaller profitability than the short-term bond, we have something like this, an inverted yield curve. This scenario is important because it has been related to crisis. Exactly. Only that in the last time we have a kind of negative yield curve, and this not anticipating, that's not going to be an incoming crisis, right? This is the slope of the US yield curve. This is reported by the Federal Reserve, and what they take is long-term bond. They take the 20 years. It's the 10 years. They complete as 10 years minus 2 years. Don't ask me why they do that, but that's what they do. They compute the 10 year in excess of the 2 years. This is not the yield curve. This is this differential. So it's telling me about the slope. Most of the time we see positive, right? So that's this yield, the slope. That's this yield curve. Sometimes we see negative. That's the inverted curve. In the period in which this line is negative, that was inverted. Now, why this is important? You see over the last 40 years, 40, 50 years, right? If we go there, that's how it looks like more recently. If we look at the maximum, right? This is probably yesterday. Okay, so it was something like the difference between long-term bond and short-term bond was like a 0.5%. The gray bars, you know that is signaling crisis. So see what has happened historically over the last 50 years. Anytime you've seen an inverted yield curve, that situation has preceded in a non-causal way. So meaning there is not necessarily a cause-effect relationship here. But somehow this has anticipated a crisis, an economic crisis that happened in the 80s, later in the 90s, in the 2000 beginning crisis, 2009, this you already saw it, and even in the COVID. Shortly after the COVID, the yield curve was inverted. And we have an inverted yield curve in the US over pretty much 2 years. So everyone was sort of fearing, being really afraid of an incoming crisis in the US. But it doesn't seem to come. Maybe seems to be the first time that the inverted yield curve over the last 50 years is failing to anticipate the crisis. Now some people are sort of trying to remark this idea. What happens really before the crisis is that you get a negative and inverted yield curve, and then what really happens before the crisis is a very sudden increase in the long-term bond. It must be really steep. The function turns very, very, very steep. And this situation happening here, right? See that period? Suddenly it goes very, very fast, very quickly up, there, and now some people are saying over the last weeks this spread seems to be accelerating. Some people say that's the real symptom of an incoming crisis. But right now it's good news. Over the last 2 years, we were explaining this in the master, says, sorry guys, I have bad news, seems to be the signal of a crisis. Now what happens, this is not really a cause effect. There is nothing that says mathematically this situation is going to happen. It was taken as a warning indicator, as an advanced indicator. But okay, that's what happened. Okay, so we can take this yield curve as a basic information. That's for starting from 0 coupon bonds. And now the problem is that we don't typically have, when you see this nice yield curve, right? We don't typically have those bonds at any maturity that you may possibly need. I want to discover something, like in the exercise that we're gonna do, I want to discover something which is not 1 year, nor 2 years, is 1.0376 years. So can you give me the yield associated to this particular maturity, and we will discount that at this rate? And the question is, of course you don't have that. You have a bond with maturity 1 year, then you have another bond with maturity 2 years. So we need to use some sort of interpolation technique in order to be able to produce the yield to maturity, given other yields associated to any maturity that you may possibly want. And this is used by using a special modeling, a very well-known model, and this very short introduction to fixed income I want to present you. This is called the Nelson-Siegel model. You have, whatever you see, remember, those things, those are the links to the original paper, just in case you feel curiosity about how this thing goes. What we are going to do is very simple. We will have different maturities, different points, right, of different bonds. And we want sort of to construct a single curve that fits everything. You are seeing with Alberico a way to fit model, the regression model. The idea is exactly the same. The problem with the regression model that you are seeing with Alberico is that the OLS, the regression model, produces a linear fit. The regression model captures something, a relationship of the y variable over the x variable, and here for us x is going to be maturity, it's going to be time. but the relationship between y and x must be linear, what you fit as linear regression model. When you say something like y is given by alpha plus beta times x, that's the line. And what you are seeing is, but only it's not a perfect line because we have the random influence of these shocks that makes things to misalign, right, to go randomly around this theoretical line. But the regression model allows me to recover the hidden line which underlies this expression. We are going to do exactly the same thing, but we cannot resort to a linear model because the thing that we want to capture is not linear. This is clearly not a line. I cannot fit a line on this model. I need to do a kind of curve fitting. So the technique is more complicated because we need to use a kind of richer dynamics. This is the simplest case possible. The simplest, but not just unique. We have other techniques which are more complicated. All right. What is the Nelson-Siegel model doing? The Nelson-Siegel model is saying the yield to maturity that you observe, so to the left in this equality, is what you observe. This is the real value. Okay? The real value is going to be the value that the model predicts plus an error. This is the same idea than this thing. What you are seeing in the regression model is my y variable that I observe is the variable that I can fit, and this is the structure of the fitting, the line, and everything that doesn't match what I'm saying, the error that I make goes into this kind of bucket. The equality is possible because I'm using this kind of dirty tree. Imagine one number. I'm going to try to figure out what that number is. Your number is my guess, and everything that may be a difference is going to be the error. So of course, this equality is going to hold always. The number that you have in mind is the number that I'm going to say, 7, and whatever this is not matching exactly is the error. And of course, this is met. You have in mind, I don't know, 9, I say 7, then the error is 2. You have in mind 10, I say 14, then the error is minus 4. And of course, you are systematically matching this equality. Life is what you expect plus surprises. Indeed. So all these models, the difference of these models is how you characterize what you expect. In the linear regression model, what you expect takes this form, a line. In the Nelson-Siegel model, what we characterize, what we expect, takes a much more complicated form because we want to give flexibility to the model to capture the curve. So it cannot be, I'm sorry, it cannot be that simple. It needs to be a more complicated function because we want to fit curves. So you see the exponential part. You see those ugly exponentials that we immediately dislike, yeah, because we are very familiar with the proportion and the line, and this is pretty much the only mathematical relationship that our brains understand naturally. Everything else needs a lot of training and exposition. So you move away from the line, I pay for 1 beer 2 euros, if I take 3 beers I will pay 6 euros. Any way that stays away from this simple proportionality relationship, it takes time to our brain to understand. So you want a curve, you want something polynomial, you want something involving exponentials. The immediate reaction is, oh my God, what the hell is that? This is an expression that uses the flexibility of the exponential function, which is a kind of curve, and we will twist those things in order to accommodate the fitting to fit the dynamics of the interest rate curve. And this is enough. We will have a model in which the predictive part is this thing. This is the structure that we are going to use to predict. Give me the maturity. give me the values of beta 0, beta 1, beta 2, and this lambda, and I will give you the predicted value. And remember, everything that is not real, but my prediction, the difference is going to be treated as an error. So what is the strategy in estimation methods? You will have an error, which is the difference between the real observation and what your model says. A good model produces small errors. A bad model produces big errors. That's a discrimination method. I'm going to sort of use my model to calibrate those parameters in order to make this error as small as possible. I will not care whether the error is below or above, comes from below or from above. An error is an error. So we are going to work with a loss function, which is the square error. We square, not to be sensitive to whether the error comes from the fact that my prediction is greater or smaller. And then we are going to design a loss function, which is I want to minimize the sum of errors squared. So we are going to calibrate those parameters of the model, beta 0, beta 1, beta 2, and lambda, in such a way that we make the sum of errors between what happens in reality and our predictions as small as possible. If you go into the linear regression model, the setting of the problem is exactly the same. What is the advantage of the OLS? What is the advantage of ordinary least squares? The problem is so simple that you have a closed form solution to your estimations. You know you have a recipe to construct the solution of this alpha and this beta. And this is what you are studying, right? The solutions will be this x prime x inverse x prime y. And that's why the linear regression model is our failure estimation method. You don't need to do something very complicated. You have the solution, and that solution can be implemented because you have the recipe. You have the closed form expression for the solution. Now, when you move into something much more complicated, as we are doing today, you miss the analytical solution. You will state an optimization problem, but you will not be able to write on paper what the solution is done. You will have to use numerical optimization, and that's a huge disadvantage. You will need a computer. You will need special software equipped with algorithms able to look for the function that we want to minimize. We want to use this sum of errors squared. That function is convex. You need to evaluate that function somehow and try to determine that minimum value. Okay. Stata, MATLAB, Python have those routines. In mathematics, the contribution of mathematicians over the last 40 years has been massive in this regard. And we have the perfect tool, the computer. And now even Excel is equipped with algorithms, with routines that can engage in numerical optimization. So this is what we are doing today. And remember guys, sounds scary, sounds super sophisticated. If it can be done in Excel, it can be done. So Jesus, if you like it the first homework, if you like it the first workshop, that you post it there, you are gonna like this one. It's gonna be way more sophisticated. So what we are doing is we are gonna go to the US. I may use the European data, but you know, for that this is an international master after all. So I'm gonna take this middle ground, not to be sort of accused of big bias, home bias. We are going to go to data of the US. We're going to see what is traded in the US. We are going to get the yield curve, the last yield curve. We'll see there is a lot of them. This is sort of a store every day. We have data for every day over the year. We're going to pick up the very last one. We're going to fit the Nelson Seeger model. We're going to reconstruct the curve, and then we're going to value our contract. Everything to do what a bank today would do. A bank today, at the end of the day, in the back office, And of course, this is nothing that the guy that is in the, you know, when you enter into the bank, it's not going to be that guy. That guy is there just for selling things. I'm talking about the real position that you are interested in, the back office. In the back office, someone is saying, look, we have this agreement, we need to register that in our books, and this is how we value this thing. So you're gonna learn how to do that. Fair value first time, okay? Break, 15 minutes. Coffee, bring caffeine, sugar, you're gonna be go for it, and we engage in Excel business.